All right, today we're going to dig into a really popular trading strategy, the 52-week high breakout. You've probably heard of it. The whole idea is to find stocks just as they're smashing through that big year-long price ceiling. We're going to break down why it works, what to look for, and exactly how you'd go about trading it. So let's just dive right in. I mean, this is the big question, isn't it? The one every single trader is trying to answer. How do you find those explosive moves before they take off, instead of just reading about them the next day? Well, the strategy we're talking about today, it offers one possible answer to that puzzle. And the answer is surprisingly simple. You follow the big money. See, a stock doesn't just accidentally hit a new 52-week high. That kind of move almost always means that large institutions, the giants of the market, are buying up shares in a big way. So this strategy isn't about trying to predict the future. It's about spotting their footprints in the sand and, well, riding the wave they're creating. Okay, so we know the why behind the strategy. Now, let's get into the what. What exactly does a perfect setup look like on a chart? Let's go through the visual clues that tell you a powerful breakout might be setting up. The first word you absolutely need to know is consolidation. The best way to think about it is like a spring being coiled tighter and tighter. The stock price just moves sideways, kind of bouncing between two lines, not really going up or down. It's building up energy, and the tighter that sideways movement is, the more explosive the potential move. Here's a textbook example with the stock BSE. See that box I've drawn? The price is just stuck in there, moving sideways. That's the consolidation we're talking about. And then, look what happens when it finally pushes above the top of that box. The price just takes off. That's the move we're hunting for. Now, here's another little detail to look for, and you can see it on this card trade chart. Notice how the price keeps bumping its head on that upper resistance line over and over again? Think of it like someone knocking on a door. The more times they knock, the weaker the door gets. Each one of those touches is chipping away at the sellers, making a breakout more and more likely. Okay, now here's a part that might seem a little backwards at first. While the stock is in that boring sideways consolidation phase, you actually want to see very low trading volume, dead volume. Why? Well, it tells you that there's not a lot of selling pressure. The people who wanted to sell have already left. The supply is drying up, which makes it way easier for buyers to eventually take control. So if we want low volume during the quiet part, what do we need for the main event? The complete opposite. Look at this MCX chart. The moment the price breaks out, look at that massive surge in volume. That's the confirmation. That's the starting gun. It's the big institutions finally jumping in with full force, giving us confidence that this move is the real deal. So you've found it, the perfect setup. The consolidation is tight, the volume story checks out. Now what? How do you actually put your money to work? Let's walk through the actual step-by-step game plan for getting in and getting out. It's a pretty straightforward 4-step process. First, you're looking at the daily chart, the big picture, to find that strong consolidation pattern. Then, you zoom into a 1-hour chart to really pinpoint your entry. And then, most importantly, before you even think about clicking the buy button, you figure out your exit plan, where you'll get out if you're wrong and where you'll take your profits if you're right. And that brings us to what is maybe the single most important question in trading. What's your plan B? If this breakout turns out to be a fake out, how do you protect yourself? Where is your safety net? And the rule here is very clear and very strict. Your stop loss needs to be tight, somewhere between 5 to 8% below where you got in. This isn't a strategy where you just cross your fingers and hope. You have a clear, defined line in the sand that protects your capital if the trade goes against you. All right, now for the fun part. Let's say the trade works perfectly. The stock is soaring. How do you decide when to cash in? When do you take those chips off the table? The approach here is really smart. Once the stock hits a 15 to 20% gain, you sell half of your position. Just book it. That locks in a nice profit and usually covers your initial risk. Now the rest of the trade is basically a free ride. You can let that remaining half run, maybe trail your stop loss up, and see if you can catch an even bigger move. We've gone through a lot of details here, so let's try to boil it all down. Let's put a strong, high-quality setup side by side with a weak one so you can really see the difference. This pretty much says it all. On the left, you've got all the green flags for a strong breakout, tight consolidation, lots of touches on resistance, dead quiet volume before the move, and then a huge volume spike during the move. On the right are the red flags, a loose, sloppy pattern, low volume on the breakout, basically the opposite. Your job is to be patient and wait for the A+ setups. So let's just recap the entire system one last time. The logic, follow the big money. The setup, a nice tight consolidation. Your confirmation, that essential volume spike. How do you execute? Find it on the daily, enter on the hourly. And your risk management, a strict 5 to 8% stop loss with a plan to take half your profits at 15 to 20%. See? It's a complete plan from start to finish.
And this all leads to a much bigger question, doesn't it? We've just laid out a very clear, rules-based system. Is the real secret to success just having the discipline to follow a simple system like this? Or is the market always one step ahead, more complex than any one strategy can account for? Something to think about. Thanks for tuning into this breakdown.